You're welcome to the second workshop in our series of pre-tournament workshops for Summer Holidays Ivy, hosted by Vacationspars. Today, we are going to talk about finance and the stock market. And we have with us Erasmus. Erasmus is a finance bro and he's a professional in all things finance. So he's going to help us clarify some of the questions we would have, and he would give us an in-depth presentation. We're so happy you were able to join us, Erasmus, and you're welcome.
No, thank you very much, Supanana. I think it's been such a long time since I spoke to debaters, and it's always nice to come back and come and share. And when you said you needed to learn about finance, but I got the same sort of like heartbeat I used to have when we were given finance motions to debate. And I just forgotten that I've now spent a number of years doing this anyway, and I've survived. So we'll all be fine. So hopefully what I'll be able to translate to everyone today is sort of the basic understanding that would help you to survive any finance debates. Just the general understanding and the structure of how some of these things work. Like, for example, what's the stock market, what's an IPO, why do governments care about it? Why do investors care about it? Why does everyone panic every time we see things in the red? Give you a fair understanding of these things. Then afterwards, I'm going to be sharing resources and materials which would help you to do some further reading into the subject if you are not deterred enough. Okay. So I don't want to waste too much time and want to start going into the details of this. And before I start, just a bit of structure to the presentation. This is not going to be like like a classroom presentation. What I'm just going to do is highlight some of the biggest questions, and then I'll ramble and talk through it. Okay. What I'm hoping I'll be able to do is to trigger some questions within you that by the end of this 20-25 minutes period, you'll be able to ask good follow-up questions, and then over there we can discuss some of the things more in detail. So I want to start with this question. What is the stock market? Because I know that's one of the biggest questions that people have. And anytime we hear about the stock market, it's in relation to a crash somehow for some weird reason. People don't really get excited when the stock market is doing well, but they are quite panicky when there is sort of a crash because um for some reason they know that it is going to affect them, because we know that there are some things and feelings and happenings, how the government reacts, the way in which it positions itself, which eventually is going to affect the money in our pockets. At least for us as students, we know that it affects the adults, and then we don't get much pocket money. But I think it's very good to approach this by asking the fundamental question of what the stock market exists to solve. The stock market is not an open physical place. Okay. And it's one of the more difficult concepts to understand. It's not a market in the literal sense of Accra market or Tema market, or a place where we buy and sell things. A stock market is more of a framework, or a stock market is more of an idea, and is a place where you have companies just being able to trade off value and just being able to receive funds moving forward. And I think hopefully I'll be able to convey that understanding in there. But I want to take your mind back to thinking about the economy, right? In every economy, you need money within the economy in order for people to thrive, and in order for the economy to expand. So every economy needs capital. And if you go down to the basics of economics, where we consider all of the factors of production, we have labor, land, capital, and then entrepreneurs. We all know and intuitively understand that capital is perhaps the biggest and the most important part of all of this. It has a multiplicative effect in a way in which it is able to boost production. And in fact, without capital, no business is able to come about. So, understanding the stock markets begins by understanding that every economy needs and requires capital in order to function. The elements of the economy, as we all know, include businesses and consumers and governments also, because there are different and multiple stakeholders within the economy. But businesses are the engine room and drive growth. They are the primary growth factor within every economy. So if the economy is going to get better, businesses need to do well. They need to continue to produce. And what are the examples of some of these businesses? It cuts across a wide range of things. Think of everything that you need as a human being. Look around you within your room. Everything that is before you is produced by a business. Fundamentally, they make sure that they provide all of the resources required for our subsistence. So before a business can grow, it needs capital. So businesses that make books, businesses that make your clothes, shoes, that build your houses, that do all of those things require capital. And the stock market is one of the ways by which they can be able to get capital to expand and to grow. If you want to start a business today, probably you ask your parents for some money or you ask your friends to borrow some money, which is a good way to do so. But essentially, when you think about businesses to this at the scale at which we're talking about, like your Nestles, your Apples, who are producing your phones and watches, or your MTNs who are providing telecommunication, it will be very, very hard for MTN to start building mass infrastructure using money from mommy and daddy. Okay, so they need to think about a place where they can go and get capital, and that's why the stock market exists, because it brings together people who have money versus people who need money. Okay, people who have money and are unsure what to do with it versus people who need money. So fundamentally, it is an allocation machine or an allocation mechanism. So think of it more in that sense rather than a physical place where some of these things are being traded. And indeed, there are physical elements and infrastructure within the stock market which you need to think about, like trading floors, trading houses, clearing houses, things like that. But fundamentally, from a debate perspective, you need to understand the concept in this way. You don't require too much understanding of what some of those physical structures entail before you know what the stock market does. And one of the key purposes of the stock market, then, like I said, it's an allocation mechanism, is to ensure that there is efficient allocation um, uh, uh, of resources to companies who need it. And that's why you hear about stocks going up, stocks going down. Because when stocks go up, or when we say the stocks of a company going up, it means the company generally is doing well. When it's going down, it means it's not doing well. And no one wants to invest in companies that are not doing well. Everyone wants to invest in companies that are doing well. So it really helps us to define the winners and the losers and allows us to bet on the winners, which means that the companies who are doing well are going to receive more capital and they are going to produce more goods, perhaps more efficiently, for all of us to be happy. And that's how the company expands. We don't give more money to the companies that are not doing well. And without the stock market, we wouldn't be able to know and tell some of these things. Perhaps I'll go into more detail as to what shows that a company is doing well versus it's not doing well. What are the elements which drive the stock prices down? But for now, I want you to use your general understanding and appreciation of what stocks are, and it still does the job in helping you understand these elements. But before I move on to the next part, I want to talk about what exactly is a stock, right? A stock is a bed. That's the very first thing. That's one of the literal definitions of what a stock is. But in this instance, that's not how it plays out. A stock eventually, and the other name for this is shares, and you hear me use them interchangeably. The original name is shares. Is literally when you have the sum ownership of a company and then it is divided. What is your share? So think of it like a very big pizza. Think of Apple like a very big pizza. And then we say, how are we going to share this? So we have a way in which we've divided it, and one piece of it is a share, right? So depending on how many pieces of it you have, it tells how much of the company you own. So you would realize that the CEO probably owns some bits of it, but you also have certain institutional investors who also own some bits of it. You also have governments who also invest in shares. So, for example, in Ghana, I know Vodafone is owned 30% by the government. So the government has 30% ownership or 30% of the shares that a company has. And the shares, the other name for it is stock, the other name for it is equity, right? Um, it might be good to help you understand what equity in itself means, but it's the same thing. It's ownership, right? It's ownership. Um, so that is literally what a stock means. And so when we are within the stock market, we are trading the ownership or the units of ownership within these companies between ourselves in order to create more value. Cool. There are two kinds of markets which exist within the stock market, or broader kinds of trading, which is going on. There's the primary market and then there's the secondary markets. And especially as debaters and in many debates I've judged, people tend to confuse the two because the company, it seems, receives money only once. Like when they go into the markets, they receive money once. So what are they trading? Why is the money going up? Who gets the profit that's coming and all of those other things, right? Let me start with the primary markets. Before every company starts, naturally, before they start, uh, they want to issue new shares or ownership in order to get money from the public to fund their plans. This doesn't always work this way. It doesn't work that from the start you just go to the market because, believe it or not, it's quite competitive and nobody is just willing to give money to anybody. Because if you think about it, if you're a new company coming into market right now and you need money from the stock market, you are literally competing with all of the companies who are already established within the stock market. So good luck competing with Apple for the money of maybe Jeff Bezos or someone like that, because they are more likely going to give their money to the company that is doing well versus the company that is not doing well. So what most companies do is they try and use alternative means of funding outside of the stock market. And in fact, there is a whole world outside of the stock market for investment, right? But today's lesson is focused on the stock market, so we'll stick there. But companies find a way to grow outside of the stock market, and that can mean using private capital, bootstrapping, mommy and daddy, um, or getting money from friends, or even getting money from other investors, so on and so forth, outside of the stock market. But before, but before they enter the stock market, which is more or less this public, official, institutionalized place where the government has recognized and said this is the activity that you can do. Everything else almost seems to be on a private basis. I mean, there are some distinctions in there, but this sort of general divide is good for you to understand. Most companies, like I said, grow initially and then approach the stock markets through a process called the IPO. So the IPO stands for Initial Public Offering. And many of you would have heard quite recently that um, SpaceX did their initial public offering. But SpaceX is not a company that was born yesterday. SpaceX has existed for a very long time. So it gives you a very good understanding of the concepts that I'm talking about, that companies strategically grow themselves and prepare to enter into the stock market for more or less strategic reasons. Now, the stock market is that bigger pool, and the business reason behind this strategy is so that they can make more money. Because if you enter there as a company who everyone already knows to be doing very, very well, it's like you've built up steam and you are now prepared to get people to be fighting over you. Okay. If I was to bring this back to football, and I'm sorry for those who don't understand football, but for those who do, within the transfer markets, there are some players who choose to stay within certain teams, play one more, two more seasons within the smaller team in order to increase their hype, score more goals, right? So a good example perhaps this season will be Yan Diomande, who maybe is a good attacking player. He scored as many goals in the La Liga. Big teams wanted him, and he said, "No, I'm going to go to stay within a smaller team. I'm not going to come to the big boys yet. Why? Because I want to continue to develop. If I move right now, my stock will be very, very low. If I wait till I'm doing very, very well and now I enter into the big boys league, my stock will be higher. I'll be paid more. I'll receive more interest because more people would want me and then my value is going to go up." think of it in that same way. That's essentially what SpaceX also did by operating for a very long time. I mean, this is not the only reason, but by operating for a very long time outside of the stock market and doing an initial public offering, they most likely increase their prospects in there. Now, when they do this initial public offering, and I don't want to go into the details of what the initial public offering is, but it's essentially you now going to the market or to the public and saying, here I am, give me some money, and I'll make sure I'll give you back the money and with profits. Okay, so they issue new shares and people buy up the shares and then the money goes to the company. And this is what the company uses for most of its production or to expand. We spoke about the factors of production. So it now receives the capital and it uses it to build factories, hire more workers, to invest, and generally to expand the company. Sometimes it could be used to build the company even right from the scratch. Just to make a quick note about the initial public offering, because it's a very, very complex process. No, not too complex, but it's a process that it might be helpful for you to understand or read more about. But there are different vehicles for doing the initial public offering. They don't just go to the market and say, give me money, right? They usually need corporations or banks to back them up. And these are the large scale investment banks, which you probably hear or know about. So they back these companies to say, hey, we've looked at the company, we've looked at their numbers, and we've given them this value as to how they can sell their shares. And then these investment companies do is they buy some of the shares, which will serve as guarantee or trust to everybody that look, we've backed you. We are already in the market, we're already in the institution, we've done these deals before, and we have bought and own some of these shares, which means that if it's risky, the risk is also going to come to us. And all of these help to helps the company because it gives it the trust going into the markets, and therefore there's a very, very specific process that comes with it. You need to pass all of the documentation. There's a lot of hurdles and checks. Because you're coming into the public space, and if you are coming into the public space, there's a need to protect the public. So there's a lot of laws around your corporate governance, around if you're abiding with regulations, compliance. And that's why sometimes also companies can take a while to do IPO. I think the reason I'm stopping to share this is because it can become very, very valuable in debates, especially where you're arguing whether a company should go public or not. Because if you need to abide by all of these strict rules, there are always limitations that or sacrifices you need to make compared to when you don't need to abide by all of these regulations. Just something to note. So that's it for the primary markets. It's the initial instance where companies go to receive the large bulk of capital, and this is where they get a direct investment from investors to build the companies. The next part is the secondary markets, and this is the more speculative part of the stock market, and this is the part that people usually get confused or about, or they hear about on a daily basis but don't understand. Within the primary markets, the companies receive the money, but within the secondary markets, investors trade shares with each other, and the company does not necessarily receive any money. So why then does it matter? Because active secondary markets encourage people to buy shares in the first place. Okay. Active secondary markets encourage people to buy shares in the first place because we can buy and sell the stocks between each other and buy the shares between each other, and because of the buying and selling, the shares value can increase. Then there's a reason to buy it when it first comes. You understand? If we were just buying it in the beginning and relying on the company to just give us value, the company's ability to do so in the long run is very, very limited. But because of the secondary markets where I now have a share, I bought the initial one, but I can now sell it to you, Super Nana, for a higher price. It means that there's reason to go into business because there's profits to be made. And this liquidity is what increases people's willingness to invest. The fact that you can have a small pool of money, but it can grow much bigger as well, increases the willingness to invest and invites more capital into the stock markets. So without secondary markets, primary markets can become much, much weaker. And I think this can be a fantastic extension within any debate. Okay. So why are we willing to trade, buy and sell shares within each other? There are three main reasons. First is dividends. Now, dividends, the literal explanation and what dividends comes in the name is dividend. Is literally there's a game that we used to play, a kind of football game called one chandy. So it's literally whatever profits or profit that the company makes within a year is going to divide it amongst the people who own it. Okay, so if we make 10 CDs by the end of the year and we have 10 investors, we give them one CD each. Okay, and it's just a way of profit sharing. And so when you own shares within a company, you are likely to receive dividends. um I needed to add at the beginning of this presentation, perhaps permits me to record and add it, that this is not financial advice in any way, but dividends, not all companies provide dividends. Some companies have a different strategy, but there's a lot of companies that if you own their shares and they make profits, they are going to give you dividends. But secondly, it's also for capital gains, right? We spoke about capital. And when people are willing to invest capital in you, they expect a profit or a return, which means that the companies can grow at a much larger rate, which gives you the ability or the possibility for being able to expand the capital that you have. And lastly or thirdly is for influence. Believe it or not, uh, some people are interested in the governance or the way in which people run companies. Okay, so every shareholder, and this was one of the characteristics of having shares, or when you're an owner, you are a partaker in the decisions which the company does make. So there is something called a shareholders meeting, which happens every quarter, right? And within this shareholders meeting, the company gets to present their financials and present the progress. And every company within the stock market is mandated to do this, which is the reason why not every company decides to go to the stock market, because it's a very, very, very dicey and delicate process. Every 3 months, you need to go into your company, find out every detail of information, and you need to let people know, and you need to be right about it. In fact, it's one of the most important things about a company, given it's at the head of them making money. So within these shareholders meetings, you make decisions. What's the direction of the company? Which product are we investing in? Which markets are we investing in? Which markets should we not invest in? In fact, sometimes even how many employees are we keeping? Are we keeping our uh, cost high? Are we keeping our cost low? Just the owners get to express their opinions, and sometimes some of these decisions goes beyond the economic. It goes towards how the company is behaving within the public. So a lot of companies who sometimes things happen and they care about the public image and they're coming out to apologize and things like that. And it's not maybe because they necessarily care about the bad thing that they've done, but because sometimes they have some investors who care about that, right? For example, some corporations who do bad things within other regions or other countries. So multi-international companies who maybe are engaged in oil spills in Nigeria, and they may have Nigerian investors who are like, I'm not happy with how you are behaving within Nigeria, or the Nigerian government may be an investor, so they may not want to piss them off, and therefore they do something. And you are going to have a lot of these debates where people speak about advocacy groups owning shares within companies or as a means of being able to extend advocacy. So you have sometimes environmental groups who own shares within oil companies in order to steer the company to be environmentally compliant. So the reason I've spent a lot of time on this point is because it's one of the things that's very, very easy to miss out on, but it's a huge factor uh, within a lot of debates. It's shareholder influence. But most shareholders want more profit. So most of the time within these meetings, they care about what affects profits. Okay. All right. It's just an important thing to note from here also. Um, Share prices in in themselves, because we've spoken about the reason why people are trading stocks between themselves, but share prices in themselves represent expectations and don't always represent the present reality or value of the company within the market. So sometimes you see that someone's stocks is rising. Um, Back to the football analogy, when Mbappe was 19, we knew his stocks was rising, and PSG probably had to pay a lot of money for him. They are not paying 100 million for him because he's worth 100 million now, which seems like a strange thing to say, but it is always for how much do we value him for the future. If we get this guy for 100 million, we win a couple of Champions Leagues and we earn maybe 300, 400 million. So he's key, right? Um, so stock prices almost always represent the expectations of the directions of the company than than the present reality. And that's why sometimes even during a recession, a stock market can be rising. And we've seen that a lot this year, where there's been a lot of sticky prices that despite all of the things from Trump, uh, from the war in Iran to the war in Ukraine, post COVID effects, the level of instability within the world, and all of these AI disruptions within the markets, all of these things, when people are saying there's likely going to be a recession, if you're following the news, we still see the stock markets performing really well. And it is because we are in an unprecedented time where people just don't think that the stock market is going to fall. People just don't think there will be a crash. Like as much as everyone is saying the numbers show there will be a crash, people just think, well, we are really not going to allow that, right? And that's why markets can still rise during a recession. Markets can still fall after good profits. We've seen it before that someone releases good AI, and it's supposed to be very, very good, or like maybe there's been huge profits from some of the tech companies, and right after that, you've seen the markets fall. It's because maybe people are predicting that, well, off the back of these good profits, we are anticipating that something bad will happen. And it's also a key factor as to um, uh, uh, the election cycles and how it influences stock markets, right? Because people anticipate how politicians are going to, or the government is going to interact with the economy or within the stock markets, and therefore change their notions on what you are doing. So the major takeaway from this is that markets therefore are forward looking, and in general, governments are often judged by expectations rather than outcomes. And there is a deep, 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 deep philosophical underpinning to how markets in themselves work. And I'll look to see if there is some resource that I can share on this, but there's a deep philosophical underpinning to this because most markets and businesses are established on the basis of a going concern. And in fact, as a human being, your existence is based on a going concern. There is your ability to show that you will be in existence for the future. And in fact, most of the decisions that you take as a human being is based on your assumption that you'd exist into the future, and you exist as in one way or another. Maybe because you're in law school, you would exist as a lawyer. You be a lawyer in the future, so you invest more in your law books, or you invest more into debates and doing all of those things. You are perhaps in this training because of you're thinking that you are going to exist in the future and compete in some future tournaments, and you are going to use this piece of knowledge and win that debate, and maybe that will be the final of PAUDC and whatever. So there's a deep philosophical underpinning to this. In fact, most people in a country judge their governments based on these expectations rather than just the outcomes which they get right now. Are you taking us in the right direction? And we've seen a lot of disruption, for example, within UK politics, because people are just not convinced by the fact that there is an established going concern or that the government is going in the right direction. The expectation of the government is super, super different. So there is a deep philosophical underpinning as to how why the stock market exists and why it exists in this way. Cool. I think I'm doing well for time. I'll spend a few minutes just talking briefly about why governments care about this and do some stakeholder analysis, and then we can start the questions. But I think I've covered a lot of the more basic stuff. Okay. Um, okay, why do governments care? The stock markets matters because it affects every part of the economy. And just like I explained in the beginning, this is where all businesses come to play. So this is where, if this is where all businesses come to get their resources and their money, you can imagine that that's very monumental for the government. And this is primarily one, because of investments, because healthy markets reduce the firm's cost for raising capital. It's not just that you are able to get capital, because if you were to go out in the world right now and we expect you to raise any level of capital, it is going to be very, very difficult. Apart from your mom and dad, trust me, it's very hard to get money from anyone else. Your friends will probably say, yes, but I need this returns on it, I need this profit on it. If you go to banks and you want a loan, they'll say, yes, but I need this level of profit on it. So there is a cost to raising capital. That cost can look like interest. It can look like your own reputation. It can look like you actually going to physically beg people. Right, so there is a cost to raising capital. But when we have the stock market where people have willingly put their money in, the cost to raising investment is very low. And there is also a larger pool of money that everyone can sort of get. The sky is almost very, very big. And that is good for the economy, because if businesses can easily make money, it means that can easily raise money. It means that ideas can quickly get off the ground, right? It means that we can be more productive. We can invest in more productive ways of. I was about to say productive ways of producing, but we can invest in more efficient uh, production capacity in order to increase our productivity. We can be more innovative by increasing the research that we have into goods and products. The caveat here is that businesses have more money, they can easily raise money, and that expands all of the outcomes of an economic engagement. But secondly, also for pensions, right? And I think one of the biggest misconceptions amongst new debaters is that the stock market is only for rich people. They are the ones who own stocks. Not really. A lot of ordinary people and workers actually own stocks directly or indirectly through pension funds, insurance funds, and index funds. Now, just in case you don't know these things, index funds are collection of um, I would say this way, investment vehicles or funds, like people group is groups of money that or sorry, groups of companies that or groups of resources that we've sort of put together in order to allow for people to invest in. So an example of an index can be the S&P 500, where we just group the top 500 companies in the world and we say whatever money that we get, we are investing into them quite generally overall. So, for example, if we have $10, instead of investing in, say, Apple, which is the top company in the world, we would rather just equally invest in all of these companies. And the logic here is that if one company does well, but the other doesn't, we can make up for the losses of the other one through the company that does well. And the general theory or idea here is that if these are 500 of the best companies, then we can never lose or we can never fail, because we know that they are always going to outperform the rest of their competitors or the rest of the market. And the S&P 500 is maybe just one way of looking at it. We have a lot of other indexes like the Dow Jones, etc. Some people group maybe agricultural companies only, or just they just look at who are those invested in commodities and say that's the area I'm going to look at. So those are index funds. Insurance funds, as you well know, insurance is when you put up money or you pay certain premiums in order to provide you security for an outcome which is yet to happen. So, for example, you get health insurance because you don't know what will happen to your health in the future. So you pay bits of money now or small money now, so that if there's anything that happens to your health in the future, you get some money to be able to take care of it. And when insurance companies take this money, they stand the risk that everyone who puts in money would get sick or would fall into that tragedy and they will have to pay out. So they need to find a way to grow this money. Same for pension funds, right? When you pay your pension, people think, okay, you pay your pension and the government keeps it for you, and then the government can give it to you later. That can't happen, mainly because of inflation. Because if you pay the government 10 cities today, in the future, when they give you 10 cities, maybe 50 years from now on, when you retire and you are given 10 cities, it will look very, very different to you. It will not have the same value. So they need to find a way to continue to grow it. And they all do this by investing it back into the stock market. And it's one of the reasons why governments really, really care about stock market. So when you are in a debate and someone is arguing that, oh, well, the stock market it only affects rich people, we shouldn't care too much about it, you can show why fundamentally affects the poorest of the poor, the common man, because a lot of people who depend on pension funds don't have options. They basically don't have any options. A lot of people who depend on insurance funds, market women who've secured their businesses through insurance, etc. They don't have any options. So if insurance companies can't pay, can't do payouts, the majority of people that it affects are the common folks. So that's how crashes affects the ordinary citizens. But then also there is a consumer confidence, and you see this when uh, there's also the aspect of consumer confidence as to why governments care about the stock markets, because you see this when portfolios lose money, people tend to spend less, and it's called the wealth effect. Because if households feel poorer, if if you might be going to KFC every day, the day you have less money, you start strategizing quite differently. You start remembering that someone sells beans by by the corner. So like you start managing the money because you don't know how many days it's going to last or if conditions are going to become better. So people generally consume less, and when people consume less, it slows down economic growth, and that's why they care about this. And so they don't want companies to be coming in there performing badly and losing money, because then people tend to spend less. And governments also care for the reason of banking stability. And this is because banks own financial assets, and these pension funds also own financial assets, and these insurance companies also own financial assets. So if there is a large market collapse or if the stock market crashes down, banks are going to suffer, pension funds will suffer, insurance companies will suffer, and these sit at the gates of financial stability within the entire economy. Uh, uh, Lastly, governments also care about the stock market because of government revenue. And because when firms are growing, they pay taxes. So government gets more tax. Not only so, governments in themselves are direct investors within the stock markets. They also get income tax, value added tax, corporation tax from most of these companies. And therefore, they care about how these companies perform. And in general, they care about healthy capital markets. So the main insight from this is governments don't necessarily intervene because they love investors. You know, people say, oh, they love the billionaires and they love it's the rich people when they, when the stock market intervention happened post the crash in 2008, people still today complain that, yeah, it's the bankers who were fiddling with the economy, and then we bailed them out, right? And we gave them money, and the bankers, they went on to do things. So there might be an element of truth in it, but it's not always as simple as that. Governments need to care about maintaining the stock market, and they need to care about intervention because of the knock-on effects, especially in all of the areas that I discussed. Okay, quickly, stakeholder analysis, and this is key within debates, because when you hear stock market motion, you immediately identify stakeholders. So let's look at investors. Investors are those who put money into the stock market in the first place. That could be you, that could be a company, that could be an investor, that could be a government. Okay. They want returns, they want profits on their money. They also need liquidity, which means they may need a cash flow. So I spoke about dividends where you receive profits off the shares. So you may need a cash flow, companies to be paying you back money. And they may also need confidence. Okay. And they need confidence that things are going to get better, things are doing well. So these are all elements to think about anytime you're arguing on the side of the investor within a motion. Next stakeholder, companies. Companies require funding. Um, that's why they go to the stock market in the first place. But they also need stable valuations. What do I mean by this? Before, like I mentioned, within the IPO process, before they get to the market, they need to be evaluated. We need to tell which level are you at? Are you part of the big boys, or are you just with the common folk? They need valuations which are stable, not that one person thinks they're a big boy, the other person thinks they're a small boy. They need something very consistent. So, um, is one of the elements that companies generally are looking for, and they also need investor confidence. They need to be uh, sure they need the investor to be confident enough to continue investing in themselves, in them. Okay. The next stakeholder I'll discuss are workers, right? Workers need jobs, and like I said, the more money that companies get, the more jobs they can create. They also need pensions, which, like I mentioned, pensions generally are one of the major ways in which the stock market is funded. And they also need stable firms, because if firms are going out of business, they don't have stable jobs anyway. Next stakeholder is consumers, and consumers are the direct beneficiaries of innovation. So if there's a new product that comes out, the Apple Watch, the Meta glasses, whatever it is, they are the ones who benefit from these innovations. But then they may also suffer if firms become monopolies. So if nobody else, if there's not enough money in the stock market, or only one company is getting money from the stock market, then companies control prices, and prices affect consumers. So consumers consumers care about the stock market in this way. Next, governments. Governments require a level of economic stability, so they care about the stock market. They also need a tax revenue, like I said. But lastly, and more importantly, they need political legitimacy, because one of the primary responsibilities of governments is to provide the necessary economic conditions for citizens to thrive or to gain a healthy standard of living. And without that, they are failing on a political mandate, and therefore their political legitimacy is going to suffer. Um, the last stakeholders I'll discuss is future generations. Future generations care about sustainable investment. Without this, the innovation will not be created, which creates the conditions for their forthcoming. They also care about climate risk, um just about the fact that what the planet even exists in the first place. And lastly, they care about general innovation. And I think this framework works virtually in every debate. By identifying who these key stakeholders are and what they care about, it can help you to angle the debates to your benefits. Okay, so I want to pause here. I think this is a good time to pause, and I'm happy to take any specific questions, any things I highlighted you might want me to deep dive, or um, specific questions you may have.
Okay. Thanks for the presentation so far. It's been really fun. And I think I'm also like picking up insights myself, despite being in the same line of work. It's kind of interesting. But I had some like very straightforward questions. I think you've already touched on them in your presentation, like why sometimes even when we have bad economic news, the stock markets are still going up, right? But I have a follow-up question under that. So the question then is the stock market a fair allocation engine? Because now we could be in a recession, but the people with the capital invested in the stock market still have their capital going up because, like you said, everybody's predicting that maybe the future state of all the businesses collectively is going to do well. So then it's unfair for the people that don't have money in the stock market, then, since we are supposed to all be feeling the bad stuff currently.
Yeah, no, I think that's a fantastic question, and it's actually a legitimate question, and it's one of the conundrums of the stock market. And I think fair is probably the right word to use, because the way we understand it is, if there is bad news or things are not going well, the expectation is that the stock market shouldn't do well. And if there are certain elements who benefit despite the fact that all the right signals, this all the signals are showing in the wrong direction, but somehow they're still able to make profits. There's a question of fairness, and it also affects the consistency and the way in which we view this. There is a concept I didn't discuss, which is called the efficient market hypothesis, which is, can markets consistently price assets correctly? So at every point in time, are we pricing the assets correctly? And if and we've just trusted the stock market over the years, because it seemed to be the most objective place, right? If you're doing well, you get more money. If you're not doing well, you don't get money. So if it becomes this concept where even if you're not doing well, you get money, like people start companies tomorrow and they are getting the same valuation or even more valuation than companies who are actually doing very, very well, then is the stock market fulfilling what we expect it to do in upholding the economy, or is it just serving a few people? And this concept extends even to the question of the legitimacy of government intervention, because if you can argue that markets are able to price goods effectively or more responsibly, then the justification for government intervention is way less, right? But if we can concede that, well, sometimes there is not the efficient allocation of capital, then it justifies government intervention. And this is now coming back to your question of unfairness, and that's why I think the use of the word unfairness is a brilliant is brilliant to me, because then when we deem it to be unfair, then there is a justification for government intervention in there. I personally believe that markets are not super efficient, but this position is differs amongst any person you can ask. Even amongst the experts, their opinions are quite split on it. But I think quite generally, people just believe that sometimes there are certain actors within the financial system who have undue advantage as a result of past actions, or as a result of powers which they may hold, or influence over other actors within the ecosystem, where they can escape certain consequences or outcomes, right? And therefore it requires an intervention uh, by states in order to correct these things, and that's why states set market laws and things like that. And that's why there's also a lot of pushback on the government these days in terms of highlighting their role in allowing some of these things to fester. People generally think it's good if the stock market is doing very, very well, but there are some people who are genuinely very, very concerned about the fact that not the right things are being done, but we're still seeing record profits, because the aftermath of a crash, we need to, in case there is a crash, because eventually someone thinks this is going to drop out of the sky, it can't keep going up forever. The aftermath of it is just so devastating that we perhaps need to think about how do we intervene and make sure that things are set correctly, or do we just let it go and everyone sort of enjoys their ride? So yeah, I know it's sort of like a long-winded answer, but I like the question because it leads to talking about some of these concepts which are already big debates within the space.
Hello, Erasmus. Am I
Yeah,
audible?
yeah, I think you were
Okay, all
muted.
right. Sorry. All right. Thanks for that answer. Yeah, I think it's kind of like it goes both ways, right? Depending on what we probably want to prove in that debate. Okay. Then I think that the next thing I want to then know is exactly how much going concern at or like credibility do we give to the stock markets? Because from your presentation, it's sounding like stock markets would probably exist even beyond governments. Governments come and go, but this is expected to be there forever as long as human beings need to undertake economic activity. Therefore, then, if we ever have a crash like 2008, should we always blame the government at hand? Because it's like it's your number one duty. If you want your economy going, then look beyond your party's interest and keep it thriving because it will be here after you. Like, what do you think about that?
No, yeah, I think that's also a very interesting question, because um the first note I'll make on this is there's a distinction between the state and the government. Government can be a collective representation of a people at a particular point in time, but the state exists in perpetuity. And that can become an important distinguishing factor as to the responsibility for governments, because their responsibility is to the general welfare of the people, even beyond the term that they are going to serve in there. And I think this does influence a concept of the independence of central banks. And I know we didn't discuss central banks, but there's a way in which government intervention within um, uh, the stock market is framed. It is done through institutions, long-standing independent institutions who, like central banks, who we believe exist for the long-standing interest of the people. They are also supposed to be rational. They're also supposed to be um, fair and independent. This we know doesn't happen everywhere, but we've seen the evidence of it that for strong, independent central banks, we've seen a growth of the stock markets. And this is because investors need to trust that whatever is going to happen over there is going to be fair, right? And governments, who at any point in time are representation of certain ideologies or of the people for a period of time, cannot always be trusted to be fair due to the political motivations which they may have. But they do still have a duty to the state. They do still have a long-standing duty, and some of the actions which they may take may influence the stock market in many different ways. So, to now come back and answer your question, there's a variety of ways in which the stock markets can be influenced. We've not given governments the leeway to do everything at once. We've given a lot of the powers to central banks, and this helps to balance it and make sure that no one is sort of doing anything silly. But these are the things which help the stock markets to exist in perpetuity, and these are the things which also helps people to believe that even if it crashes, it's going to come back up, or that it's not even going to crash in the first place. I think there is an extension of your question that goes way into the future, where probably can we imagine a world without stock markets? Probably possible. Probably we'll come up with a human invention which is far more efficient than the stock markets. But for now, I think this is the most efficient one that we have. And once we continue to keep the faith that it will be independent, it will be fair, and people are going to do the right things, and that's most importantly will continue to make us money, I think it will still be in existence for a while, no matter the mistakes or the drop-offs that happen. Yeah.
Okay, all right. It's sounding a lot like a religion, and this is funny.
It is a religion, in my opinion.
Because it is saying like faith and you have to do the right things and it will reward you in the future, bro. Okay,
Yes.
I understand. I understand. The next thing I would want to know is if the stock market is going green, like you see the things going up, that is a good thing traditionally. But these days, though, we know that lots of companies are aggressively getting capital from some angel investors and some funding cycles, and they are defying the laws of demand and supply. Even if nobody wants their product, they can still keep going for 5 years, selling very cheap goods, and they are still in the, I don't know, like, I don't know how to ask this, but then does the stock
What's
market think
going on?
that, yeah, what's going on? What's happening?
Like we all don't know. Like that's the honest truth. Like I mean I've not had a very long career in financial services, but like even the top people that we speak to when we get the opportunity to talk to, they don't know what's going on. Nobody understands what's going on. The simplest way to explain it is um people have just found the demand for profit making is just so high now. Yeah, the demand for profit making is just so high now. People are just willing to take other forms of risk. I want to maybe take it from here. You know, for a very long time, interest rates in the West was very, very low. So interest rates was kept very low for a reason, and it was to prevent inflation. And so the currency for a lot of countries was very, very stable for a very long period of time. And we experienced this unprecedented success, especially after the recovery from the 2008 financial crisis, from maybe the 2010s, 12s to till about 2019 before COVID hit. It's a really, really great period. But the interesting thing for when interest rates are low is that your ability to make money within the markets is very, very low, right? Because there is an abundance of money. So companies don't need your money, and therefore the cost of raising capital is quite low, right? And it meant that the profits were quite low. And some people or rich people, I would say, and even institutional investors like pension funds, etc., still need a way to grow their money and to make more profits. So started to look for different ways to do that. And and they started to look at alternative places beyond the stock market. And I have to say though that it's not the stock market looks at one part of the entity, which is ownership. There is also the debt market, right, which is a completely different thing. I'm not even sure there's a lot of debaters who are exposed to it, but probably you in financial services know. where government bonds, private bonds, the bond markets, which is a beast of its own. So those have primarily been there ish, but institutional investors have now found a way to now go directly to people building companies and say, you know what, instead of waiting for you to build and now come to the stock market to do what you want to do, we want to now meet you at your very, very starting point because that's how we make the most money, right? So the competition now became not about who is now coming into the stock market and is doing very well, because previously it used to be that you find a good company that's doing a good IPO, you buy it, and then it will rise. But it takes a very long time. And like I said, the profit margins were small in a period of low interest rates. So now it's being able to identify them further down the chain when they are still startups, when they are still babies, and taking a chance on them, because then by the time they hit, you would have had them, at their most vulnerable point where you'd have more influence, and therefore when they explode, the margins on your capital is big. And this is what exploded the era of venture capital funds. So companies started setting up VC funds independently, looking at some of these companies, especially at the beginning. But one thing to note, and this is me throwing it, this is my own analysis, right? If you are looking at a company that's like a year or two old, what really are you looking at? They really have nothing. I mean, to us over here, it might look like 1 or 2 year company is the ish, but companies within the stock market are used to companies that, sorry, investors within the stock market are used to companies who are over 100 years old, 50 years old, 40 years old, 30 years old. They know the company inside out. And so they can establish a going concern, because a going concern is at this point always based on your history. So you have a history of making profits so people can see. But when you are 1 or 2 years old, you don't have any history. So if you're an investor making a decision, what do you make the decision based on? So that's when you realize that the factors for making this prediction changes. So one, they look at who is leading the company, because statistically it's been shown that people who have surprisingly, people who have started companies and failed are more likely to succeed in their successive ventures. So you see them giving a lot of money to people who have failed in startups, and you're like, "Why how did this guy get $6 billion to $6 million to do this thing when he failed in two, three times?" Two is built on is now the factors are now premised. The factors for investments are now premised on what we think the future is going to be, or a prediction of the future. But I'm yet to see someone who has a good and accurate prediction of the future, or like in terms of the innovation, the products, the economy, the circumstances. So people looked at WeWork. I don't know if you know WeWork. This was a company that sought to um, hire out office spaces. It was like an Airbnb of offices, but it failed. And the expectation was that if we see how we have Uber, see how we have Airbnb, which exploded now with COVID and all of that stuff, like people are going to need workspaces. So we would invest in this company. They did. It just didn't happen. It just didn't happen. Um, some people, and you can see the same thing with AI now, where people saw the dot-com bubble, the internet bubble, and they saw how companies like Google, Apple started in the garage and now became like trillion-dollar companies, literally from wherever 100,000 or garage that they were from. So if I can find the next Apple, if I can find the next Tesla, if I can find the next, I mean, for gold, it's worth all the risk. So they take the risk to throw money, a lot of money, at a couple of companies, hoping one of them becomes special. That really is the model. And that's why you are seeing high level of capital chasing like this small number of and I'll say that's the fundamental reason. The reason you are seeing all of this mess is because higher levels of capital are now chasing very little pools of investments. The number of things that we know and can be assured can give us money is now very, very little. So when we see a small company taking off, it's giving all the signs, it's getting all the money very, very, very easily. So that's my understanding of the situation. It doesn't wholly explain it, because like I said, there are so many avenues for raising money these days. There Quite recently there was the private credit market, there was a small crash within the private credit market. And before that, the private credit market was this unknown, untouched thing. Nobody really knew or understood it. No one really cared about it. Then all of a sudden, we were hearing of the kind of deals which were going on in the massive, massive deals, and realized that the exposure to those deals was quite market wide because everybody was doing it. And the reason they all started to do it was because everyone is chasing margins. Yeah, within the investment bank space, that's what they call it, the margins. Everyone is chasing the spread. Where can we make more money? Okay. And it's just because the margins within institutional investing over the years has just gotten smaller and smaller and smaller, and people are now being more adventurous with their investment portfolios.
Okay. Okay. All right. Thank you for that answer. I think like you made it very like, in depth. So I think debaters listening to this can know exactly the origin of why investors are taking huge gambles now. And also like when you were talking about the factors they now look at to do the prediction, I was hoping you would talk about when you talking about like who is leading, right? I was hoping you would mention they are checking if you have a garage. Because
Yeah, true. When did you drop out of school?
did you drop out of school? Did you go to Ivy League or did you drop out?
Yes,
If your
yes.
founder did, they're gonna give it the money. They'd give it the money. Yeah. That's so great. Since you mentioned AI, right? The next question, and I haven't seen lots of motions on this, surprisingly. I don't know, maybe the CAPs will start catching up, but people are starting to build their own AI models and feed them data from the stock market, hoping that they can make very good predictions so they can make a lot of money and game the system. What do you think about this? Do you think if they succeed and build such successful models, it would affect the core principles of the stock market? It will just become who can best gamify the system and just cash out with their AI?
Mhm. No, I think it's a very, very interesting question. In fact, I have done a debate on this before. It's interesting you say you've not seen a lot of motions on it, on algorithmic trading. But I have to say that auto, trading automation didn't just start now. And before AI came, a lot of trading that we have right now is automated. Literally, if you go to large institutions over the last couple of years, maybe 10, 15, 20, even maybe 20 years, there's not a lot of people sitting there pushing buttons now. It's really all just automated. People set their trading rules. Maybe someone has a rule, and those not involved in trading will be very hard to explain it. But you sort of have your strategy. Maybe if you are, think of it like you are playing Mortal Kombat, right? Like yours is always take Lucain and do the under I've forgotten one of the styles that I did, maybe the fire punch or something like keep doing it. Keep doing it. So people used to set that strategy and say, when you enter, okay, you bots, when you enter into the stock market, pick Lucain, always throw the fire, right? And then they leave it and then it does that. And they've largely been successful. The the obvious advantage is the speed at which trading is done, right? Because if you think about it, like I said, when you're trading a stock, like even on top of everything that we said, how much is an Apple stock? I don't know. I don't know. But if I was to take a guess, I'll probably say now it's maybe around 200, maybe 150. That might even be too much. But generally, stocks are very, very low price. You have stocks $10, $1. Some are opening at $1, $2 per share. So you really can't hope to just be trading manually and make money, right? And algorithmic trading, just automated trading, there's a term for it, it's called high frequency trading, uses automation to trade at high volumes and at a rapid speed. And another thing to also note is that the stock market is moving every second, right? So once there is a price that goes in, an interaction that goes in, um it influences the price of the share. So you see shares within the day, you spoke about it being green and red. You see within the day, there's a chart where it's going up and down, up and down. So even within the day, there are variations of the price which you can make money from. And mind you, if I've not mentioned this in the beginning, a lot of how traders, the people who are sitting there trading the stock markets, a lot of how they make money is through price variance. Like, it's buying and selling. So think of it like the traditional markets, buying low, selling high. That's all. Or making sure that when it's high, I sell. Making sure that when it's low, I'm buying. Those kind of things. So it's dependent on variance. And just as a side note to give you a better understanding of this, that's why you can see that the crypto market is people love it, right? Because you can make huge money, but you can also lose very big. And it's because the volatility is high. So a lot of market activities based on volatility. Can the price go up and down, up and down, up and down? If the price is stable, there's no money to be made. Okay. I've forgotten a bit like the question I was answering, but so the reason why they require high frequency trading is because you need to take advantage of of the prices changing quickly within the day by making huge volumes. Okay, so speed was very, very important. But there is a limit to this because sometimes, and I remember within that debate, that was the argument that I made that if at any point, like, it's good, you can set this, go on speed, make all the money you want. But the day in which you actually catch a bad break and you have a large order, the impact is just too much that it can have devastating effects, right? So that was essentially the argument that I made that due to the high volume of trading, non-observed trading, the ability not to be able to adjust, there's always a problem with it because you need a human being who is looking at it. And you also need to look at the moral concerns, right? That with automated trading, you don't have the human being who is there, who has that moral perspective to consider whether what they are doing is within the laws of the trading game or not. So there's always the risk that comes with these algorithmic trading, whether they are following the ethical concerns or because most of the time you set the goal that they should make more money for you, and then they can be more focused on that ahead of the other things. But obviously, it has its huge benefits in being able to expand the market so much, and due to that, provide a lot of volume and volatility within the market, which is exciting a lot of traders. And moving forward into the future, I think it is going to be insane. Like from a personal point of view, I really don't know what's going to happen because a lot of AI trading is going on. A lot of these bots are, in fact, these days, few human traders actually going in there. People have just set bots to go and do what they're doing. And there are huge, 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 huge concerns as to the lack of visibility because the market is so complex. And when you're looking at the stock market and there's like billions of trades going on, can you observe the patterns? Can you see what's going on? And if they are human beings are not in there into the weeds of it, studying what's going on, the ability to take advantage, the new trends, new rules which are being set within there, which is just not being observed, and the uncertainty around it is just so huge. But back to your point, perhaps we are going to go to a future where someone has an AI that they know makes more money than this, then the advantage becomes that AI, and therefore it becomes the selling point. And they are going to start selling this AI model to a lot of people who will buy it. And if you can afford it, it means you make more money. If you can't afford it, you are behind the curve. And if everyone is on the new model and you're on the old model, clearly they make more money than you, and over time they squeeze you out of the market. So I think I don't want to sound alarmist, but I think we are in really, really dangerous territories, dangerous waters, where I personally think it's important that a lot of the rules and regulations that we're thinking about, we start looking to roll them out because, yeah, I agree with you that there are large scale consequences for automation, although I can see where all the benefits come from.
Okay. Okay. Thank you for that insight. Hopefully we don't go into like a bot versus bot world where all our economy is just to be decided by the smartest AI. That would be insane. That would
We
be
probably
insane.
are there. We probably are there.
We're already there. Oh my God. This is insane. Oh boy. Okay, I have like just two more questions, and we can wrap this up. The other stuff I want to know is Elon Musk, right? He recently became the world's first trillionaire officially. Some people said we used to have trillionaires before, but we just didn't know about them. And it happened after his company did the IPO thingy. So people were really following him. And then a couple of days after, they said, "Oh, we told you it's fake because he's now no longer a trillionaire. He's like 950 billion." But then the next day, this man comes back to his status. So the question is, how much money, as in like how real is the money that you make from the stock market when we are valuing people and their net worth?
It's very real. It's very real. It's I think the concept of money changes with regards to the amounts that you're talking about. And I know I think it's always because we find it hard to consider that um how do I frame this correctly? I'll take it from a personal perspective. I've always just thought the amount of money you have is what's under your bed, what's in your bank accounts, things like that. But the way in which money operates, especially in the modern world, is very, very different. Money is hardly a physical object anymore. Money is more or less a concept. Um, Money is an invention of the human imagination and is a social good. And it's basically just the agreements that we have between each other. And the physical paper currency that you see is only a physical representation of it. So if you think about it, in Ghana, for example, people used to use cowries to represent money. Okay. Um, so in today's day and age, where there is more or less a digital representation of money, there is no physical limitations to how much money someone can have. It's just as easy as a piece of code or something which is written somewhere. But it's just a series of agreements that this person has been able to make for trusted institutions to recognize that this is the value of whatever he owns. And what he owns is the company or the stocks or the shares or whatever it is. So we all know the shares are there. The reason why we acknowledge is there is because you and I have bought it. So if what he has is not real, the stocks that the governments have is also not real. The stocks that the other institutional investors have is also not real. And therefore, we have to recognize it. And it's based on the volume of shares and then the individual cost. So if the individual cost times the number that he has is equal to a trillion, then he's a trillionaire. Even though he will never get to see that money physically, he will never get to have a bank app that says you have $1 trillion and it's written there. This is more or less book value. Okay. So I know it's hard for people to imagine. Is it like there's your bank account and you open it, you have a trillion written over there? No, that's not how it works. But people will say, then how does he get to spend this money? And we are moving into a territory now where um, probably I'm not even sure if it's a good idea to share it publicly, but but I think it's quite well known how billionaires take advantage of the system and then are able to spend their money because on paper he's a trillionaire, but all of it is in assets. All of it is as stocks, as ownership of a company, which you can't necessarily hold or get to be physical. So the way in which he gets to spend his money is by borrowing against this asset. So he's able to convince everyone that hey, I have an asset over here. It's worth a trillion, but I don't have any physical cash. So I'm going to set a part of this as collateral. You know, if I don't pay you back, you can sell this thing. It's real. Everybody knows it's real. The government knows it's real. You sell it, you get your money back. So companies, banks are also like, okay, yeah, I believe you, Elon Musk. Who doesn't know you? And they give him any money that he wants. And the good thing with him borrowing money is that when you borrow money, you actually don't pay taxes on it. But if he was to cash his shares, say he was to sell it, then he would have to pay something called capital gains tax. We spoke about capital gains in the beginning, right? Then you have to pay tax on your capital gains because you've liquidated it. And it also means that the ownership of the shares goes to someone else, which means that his share is diluted, right? So the way in which we think of making money and spending it, that's not how a lot of these billionaires operate. He's going to borrow against the money. In fact, companies are dying to give him the money because they can say, "Oh well, Elon Musk has our money," and that's a flex, right? And that's how he gets to spend his money, but still keep the value there. The odd thing is that he can do this borrow money and still go and get more assets, right? And just keep on getting more assets. He doesn't need to pay back. He doesn't need to do anything. He makes money from it back. He can pay back. If he doesn't make money from it, he can pay the interest. He's fine with it because if the once the interest is below whatever gains that he's earning on the rest of his shares, he's absolutely fine. So I hope that gives a good picture of how the
Mhm.
operations of these things work.
Yes, yes, actually. Thank you so much on that. Because I think we had a spa in Vacationspars like sometime last month, and it was basically about Elon Musk right after his status was declared, and then it was quite interesting. So
Did someone
hopefully
say anything outrageous in there?
you bet. No, like there were lots of outrageous things. No, people said somebody said, look, the 1 trillion is a conspiracy. The government needs to have somebody to be a trillionaire because when you have such high people, it sells the American dream. And currently the American dream is failing. So
Wow.
the government needs somebody to have that status. I was like, yo,
Wow. People have wild
it was
imagination.
it was crazy. Like the stuff debaters can come up with. You would love it. You would love it. Okay, one last question then. One last question then is that I want to know why
Sorry, I think you cut out for a second there.
a lot of the explanations you gave. Sorry, I was saying that I want to know why authoritarian governments care about the stock markets because presumably if you control all the electoral processes that are voted out and you don't really have incentives to care about the whether you would lose power or would you want to regulate the stock market and have it doing very well?
Yeah, no, I think the authoritarian governments perhaps even need more reason to care about the stock markets because a lot of the legitimacy of authoritarian governments come from being able to achieve economic liberation and freedom for their people because most people cannot achieve political freedom or social freedom because they get to control those ones. And the way in which they sustain their legitimacy mostly is through the economic empowerment of their people. And we've already analyzed all of the reasons why governments should be interested, especially due to the economic impact to ordinary people. So it creates a huge incentive for them to do so. But the fact also that they are in government now that they were not always in government before, right? There's even if they're authoritarian now, they are in there, they're enjoying their freedom, they still have incentives to keep the people happy because the ability to stay in government is also based on them being able to control the peace. And most of the time we think authoritarian governments can be quite like they don't have a reason to care, which it's not always true. Like even in democracy, sometimes, let's be honest, I don't think some of these governments care enough. But on a more serious point, it- you need authoritarian governments still need to maintain and keep the peace. And if there's economic turmoil, people would revolt and people will find a reason to want to kick them out of power. And even though they have monopoly over violence and they can exercise this, there's always a cost that comes with this, right? It means subjugation of your people, which means people overall long term will not like you. The reasons for revolution, we can point to more examples of your repression. Because if you're always having to repress people over time, they get fed up. So they really have incentives to make sure that they safeguard it. Everyone is getting what they want, and everyone is happy to have them in power and and keep them there. These people still have approval ratings and lots of different mechanisms by which people are able to judge the government and as to if it's doing well or not. Even if they are not able to change the head, sometimes they're able to change the local politicians. They're able to put pressure on individual governmental heads, departments. So you can see, I don't want to mention names of countries to be in trouble over here, but you can see them firing different ministers, different uh, heads of institutions, just so that they can get the results that they want. So even in authoritarian governments, there's even if when there's no jeopardy in the center of the seat, there can be jeopardy within the within the other elements of the government, which can cause them to set up and them to have an incentive to do things um, very, very well.
Okay. Okay. Thanks for that reply. I think like the part I'm taking away from this particular answer is how there are other like peripheral governments and people in those like government roles that could stand a risk of actually losing their position. I think sometimes once you hear of okay, it's a debate about an authoritarian government, everybody's focusing on the central, right,
Yeah.
on the central government and they go, these people can never lose their seats. So incentives become very hard to analyze if you're going against it. So maybe we
Yeah,
could
and
we
I
could
have to, yeah, so no, I have to add that like, I think people just have bad debates about when it's about political parties and authoritarian governments. People just have bad debate because depending on the states that you're talking about, no government is completely authoritarian. No government is completely authoritarian and dominant in every space in that way. Some have local elections, some have opinion polls, somehow have approval ratings. Some are not, even though it might be like a dictator at the forefront, they are controlled by like an executive council. Like, for example, we had with Iran that when the Ayatollah was bombed, like the council just met and appointed another one. So it tells you that the seat of power is within that council, and that council may be more subject to different incentives than what a general authoritarian government may have. There are so many other mechanisms which they care about international reputation. Sometimes, and this international reputation, people just chipping it out. But international reputation may lead to trade agreements, which and things around legitimacy, because sometimes you may be an authoritarian government, but you are seen as legitimate in the eyes of many others. Once you start killing your people, that legitimacy decreases, and they don't want that. Sometimes it's about the influence their corporations could have within other nations. So the authoritarian debates, I just think people don't have it well because they focus on the fact that there cannot be general elections. But sometimes the leader specifically can change. Like it may be the same party, but the leader may change. Um, it may be that the leader can change, but the people around him can change. It may be that revolutions pursue small reforms internally, which may have consequences because if people are ultimately not happy, you can't time down a revolution. And you can't also time down people's expression. So sometimes most authoritarian governments still find means to give people an outlet to represent it in different forms and in different ways. So you just need to be a bit creative in identifying the elements. This is a tip for anyone who listens to this free tip. It can help you in a bit. Identify the specific elements, read more about authoritarian governments to know the specific structure. Don't be quite generic and just showing that. Even with the little that I've said here, you get some, but when you read more, you find there's way, 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 way more in terms of how you're able to influence those governments.
Okay, thank you for those tips, Erasmus. I believe we are going to use it because I'm picking up some of these and then definitely going to implement them. That should bring us to the end of this workshop. And I should say, just like Erasmus said from the top, the stock market topic is so huge that this is not everything there is to know about it. Hopefully, Vacationspars will bring you more sessions in the future. Because since we also have going concern, like Erasmus said, for the foreseeable future, we would have more workshops and then you can tune in to watch. Um, Consider signing up for Summer Holidays IV if you haven't yet. And if you're seeing this after Summer Holidays IV, there are more tournaments we would do. You can join, you can check out the website, and we'd be happy to have you. Thank you, Erasmus, for your time and enjoy your day.
All right. Thank you so much. Enjoyed this. All the best to everyone. Bye.
Okay. Bye.